Hello, everybody. My name is Christian Ludwig. I'm Senior Vice President of Communications and Investor Relations at DEUTZ. Today, I would like to walk you through our fiscal year 2021 results. First of all, please have a quick look at our disclaimer. To kick it off, let's have a look at our key operational and strategic developments of the past year. Starting with the order intake. With more than 50% growth, we were able to achieve more than 2 billion in new orders. We also had a great unit sales figure. With 160,000 engines, we were able to increase the volume of the DEUTZ engines by 33%. This also was reflected in the revenues. With more than 25% growth in sales, we surpassed the 1.6 billion figure and so also met the lower end of our guidance. And finally, our EBIT before exceptional items was again in black territory. With a swing of almost 112 million euros, we posted a result of 37.2 million euros. Our EBIT margin came in at 2.3%, a swing of more than 8 percentage points year over year. That allows us to propose a dividend of 0.15, which equals a dividend ratio of 47% after 2 years without a dividend. And on the strategic developments, one of the highlights was also on the product innovation side, our new hydrogen engine, which we unveiled in August. Here we will have our first prototype going to our pilot customer, Rhein Energy, in the next couple of weeks. This is a genset working with a hydrogen engine, and the engine will be ready for the market by 2024. On our sustainability side, we further increased our exposure. We became a member of the UN Global Compact. And finally, we also had some leadership changes. We have a new board of management chairman as well as a new chairman of our supervisory board. Last year was characterized by positive as well as negative input factors. First of all, a broad economic recovery. All our relevant end markets were able to post double-digit sales growth. Secondly, the cost measures showed a positive result. Our break-even level was lowered to 130,000 units. Thirdly, we achieved the service target also already set in 2020. With growth of 16%, we surpassed the 400 million mark at 403 million. And finally, we're able to broaden our customer base. New long-term contracts with our customers SDF, Akku, and the new customer ASCO expanded our business there. But we also had to face some negative input factors. First of all, the semiconductor shortage, especially the ECUs that we weren't able to procure, led to a significant loss of sales. We estimate that more than 20,000 engines were not produced due to a lack of ECUs. Secondly, COVID-19. Several waves of COVID-19 in the past year led to inefficient manufacturing operations. Thirdly, the raw material prices. All in all, we were faced with additional cost demands of roughly 25 million due to rising prices. Not all of that hit our bottom line, but also we were not able to negotiate away everything of that. And finally, there were a couple of catastrophic events that we had to deal with, starting with the blockade of the Suez Canal earlier in the year, and mid of the year, the flooding of the Our Valley close by Cologne also impacted a couple of our suppliers. Something I would also like to highlight is the successes we achieved in our sustainability strategy last year. For the environmental responsibility, social responsibility, and corporate responsibility buckets that we are working for, we had several key goals that were met. First of all, we were able to reduce CO2 emissions from our production sites by 55%. Also, we were able to reduce the waste for disposal by 22%. 100% of the DEUTZ sites are now powered by green electricity. And 3.3% of our consolidated revenue are now attributable to our green segment. 99% of our workforce completed the compliance training, and 55% of our top 150 suppliers have received an ESG rating by EcoVadis. And finally, 75% of our production sites are certified with ISO 45001. And these positive results are actually also reflected in improved ESG ratings. This is just an overview of the current ratings that we have achieved in the last year. And just to highlight a few here, MSCI increased the rating from BBB to A in May of last year. ISS ESG rated us for the first time ever with a C+ rating, which puts us in the prime category, which means we're in the top 20% of the peer group. So clearly our sustainability efforts are paying off. The last strategic element I would like to touch today is our strategic roadmap. With our new CEO in office only for 4 weeks. Of course, we're just at the beginning of the new strategic roadmap. We have decided that we will work on a strategic agenda that will cover the next 4 years until 2025. And then there will be 2 more time horizons from 2026 to 2029, and then beyond 2030. We are working on the strategic roadmap as we speak. We'll have an update for you at the latest with our H1 results in August. That said, I would like to now dive into our figures in a little bit more detail. Kicking it off with the order intake. I already mentioned that we had a significant growth of 52% year over year. With more than 2 billion, we had the best result in order intake for the past 20 years. A clear highlight was material handling with growth of more than 100%, and the construction industry with a growth of over 80%. On the unit sales side, as I said before, we grew by 33%. And this growth was fairly evenly distributed between the DEUTZ engines with roughly 33% and the Torqeedo engines with about 35%. As you can see in our revenue development with plus 25%, we actually were not able to keep foot with the unit sales development. The reason here is twofold. First of all, in the revenue column, there of course is also the service bucket, which only grew by roughly 50%. And secondly, our product mix on the engine side was a little bit weaker in the last year, especially because a lot more sales of the below 4-liter segment. If you look at the average sales price per engine, it roughly declined 5% from our base year 2019, just to give you an idea about the input factors here. Nevertheless, as you can see from the big delta between order intake and revenues, we had a significant growth in our order backlog. It more than doubled to almost 680 million euros. That basically means that we have more than 80,000 engines in our order backlog at the end of the year. So we have basically a lead time of roughly 6 to 7 months currently in our books. But even more important is that we were able to show a continued improvement in our earnings. Every single quarter of last year was better than the quarter in the previous year. Overall, we achieved an operating profit of 37.2 million due to an increased volume of business, and especially the economies of scale, cost savings, as mentioned before, as a result of the efficiency measures implemented, and also the absence of payments to suppliers going through insolvency proceedings, as we still had in 2020. Our EBIT margin for exceptional items increased to 2.3%. So after 2 guidance hikes from 0% at the beginning of the year to 1 to 2% in April, we ended up in the lower half of our new guidance of 2 to 3%. One of the reasons for that was a rather weakish performance in Q4. As you can see, we only were able to post a 1.4% margin in Q4. There were 2 reasons for this. First of all, the operating profit was adversely affected by rising costs from the raw material side. And secondly, we also saw that the Chinese joint venture contribution in Q4 was actually negative, as we had a very weak Chinese market environment that we had to deal with. But still, overall, we performed very well. Our net income before exceptional items increased to more than 40 million, and our earnings per share increased to 0.34. Now, a quick look at R&D and capital expenditure. First of all, on R&D spending, there was no strong change year over year. The reason is that we did not save on R&D spending in the crisis year 2020, as we wanted to be prepared for the future, for the transformation of our business. So as a positive effect, the R&D ratio came down significantly by 1.2 percentage points. A little bit different is the story on capital expenditure. We saw a significant decline of almost 30%, mainly driven by a decline in the leasing expenditures, which almost halved year over year, but also our PP&E spendings was down by 20%. One of the main reasons here was that we built a new line, the line 5 in 2020, where we did not have a significant comparable invest in 2021. But going forward, please be assured we will continue to invest also in our business. So I would expect the capital expenditure to go up again in the next couple of years. Finally, looking at the working capital, here we had a very stringent management of our working capital across the group. We were able to keep the growth in working capital at 7.7%, despite the sales growth of 25%. So working capital ratio declined significantly from 18.1 to 15.7%. And the result of that you can see in our cash flow development. The cash flow from operating activities increased strongly by almost 50 million to 93.3 million. Again, the reason was the higher operating profitability, but also the very stringent working capital management. And the free cash flow development was even better at plus 57.4 million. Here, of course, the lower Capex also played a role, so we had a disproportional positive free cash flow effect. And then finally, our net debt situation. Here, we only saw a small improvement to 79.7 million. The reason is that part of the free cash flow we generated was used to pay down these liabilities. But still, when we have a look at our balance sheet, it is rock solid. The equity ratio was stable at 45.6%, despite a growth in total assets of almost 10%. Our leverage is back to pre-crisis levels. Net debt to EBITDA came at 0.6 compared to 0.1 before the crisis. So here we are in a very comfortable situation. And this means with our rock solid balance sheet, we can finance our organic growth, but also we are again in the situation to propose dividend to our shareholders. With 15 euro cent, we basically want to pay out the same amount we paid before the crisis. This implies a payout ratio of 47%. And now my final words will be on our guidance. The global market developments, as we looked at it in February, were actually quite positive. For all our segments, in all our markets, we basically saw a positive development, being it agriculture, construction, or material handling. Only for the heavy truck segment, where we only produce engines in China, we were faced with a negative market environment. Here we believe that the market will probably be down 20% this year. So basically, we were expecting to give a quite positive outlook before the start of the Russian-Ukraine war. A couple of words on this from my side. Our direct impact of the war is limited. We only had revenue of around 20 million per year before the crisis in those three countries affected: Belarus, Ukraine, and Russia. We are without an own footprint in the Ukraine and Belarus. We only have an office in Moscow with 19 people. And none of our direct suppliers are located in the region affected by the crisis. So also there, we do not expect a major setback. We have by now terminated all sales activities with Russia, Belarus, and Ukraine, and are waiting now how the situation will evolve. Something that does hit us though is the transportation of goods. We have used the rail lines to China extensively since the blockage of the Suez Canal last year. As we speak, we still have around about 20 containers on the rail. So there may be some losses if that doesn't resolve itself. We'll have to wait and see how that pans out. But still, in the big picture, it's not going to be a big effect on us. So the direct consequence for us are manageable. But of course, the indirect consequences are difficult to predict at the moment. Therefore, we have put our guidance for 2022 under review. Initially, we would have expected to sell between 165 and 180,000 engines, which would lead to total sales between 1.7 and 1.85 billion. Our adjusted EBIT margin was expected to come in a range between 3.5 and 5.5%. But due to the war in the Ukraine, the already challenging economic environment has become even more difficult. Especially, the visibility is low with respect to the supply chain, where we don't know what kind of impacts it's going to have on us. Also, price increases for freight rates, for raw material and energy are skyrocketing at the moment, and we do not know yet how we're going to deal with that. And finally, probably the most important part, it is unclear how the investment decisions of our core end markets are going to progress in the course of the year. So our guidance, as we show it here, does not include any potential effects related to the current geopolitical crisis. Therefore, we have decided to put it under review. Obviously, we will update you as soon as possible, as soon as our visibility becomes better. So I hope that you stay aboard, and we'll talk to you again after our Q1 results early May. Thank you very much for listening today. If you have any additional questions, please give us a call. And thank you very much, Seat 11A, for having us. Goodbye.
Since you watched this company video until the end, I'm guessing you liked the video. That's probably because we work very hard to create the most engaging and value-added content possible for you. If you're a stock-listed company or corporation and want to find out how we at CEAT11A can make a company video with and about you, please email us at community@ceat11a.com.